Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's number 2 economy. My name is Tony. Let's jump in.
Happy Thursday, everybody. We have been discussing the economic fallout of the Shanghai Lockdowns at the macro level for weeks now. But today, let's look closer with a specific case example in an important industry. Disruptions to sales channels, supply chains, and road transport due to lockdowns and outbreaks across the country have hit the deliveries and sales of multiple Chinese electric vehicle makers. The Chinese EV sector, driven largely but not entirely by free market demand, has been one of the brighter spots of the Chinese economy in recent years. But lockdowns are hitting the industry hard. Chinese financial outlet Caixin reports that in April, Nasdaq-listed Li Auto Inc. delivered 4,167 vehicles, representing a 62% month-on-month plunge and a 14-month low. In a statement at the beginning of the week, the company president blamed, reasonably, the poor performance on the Shanghai lockdown, expressing, quote, "The COVID-19 resurgence in the Yangtze River Delta continues to cause severe industry-wide disruptions in supply chain, logistics, and production since late March," end quote. Shanghai is a hub for key components for the vehicle sector and a vital center for shipping. The popular XPeng Inc., a low-cost EV maker listed on the New York Stock Exchange, posted a 42% drop in April month-on-month. The company's CEO warned in mid-April that if Shanghai suppliers cannot operate, then, quote, "all car producers in China will have to stop working in May," end quote. Since that statement was made, some factories have resumed operations under closed-loop management policies, but not all. There are also reports that many factories are not operating at full capacity, which would be unsurprising. NIO Inc., another major player listed in the United States, saw a 49% drop. Disruptions isn't the only issue these EV makers need to worry about either. Consumer confidence and thus demand has been hit hard in the world's largest EV market, and if lockdowns continue until the Party Congress later this year, weak demand will likely remain. Now, moving away from the scope of the Shanghai lockdown fallout and looking more broadly at the EV industry, the sector is also facing other challenges. Government subsidies on EVs are set to end this year. Leading firms including BYD Co. Limited, Li Auto, XPeng, NIO, and Tesla Inc. have all announced that price hikes are coming this year. Caixin points out that according to China's Automobile Dealers Association, China's Vehicle Inventory Alert Index in April stood at 66.4%, quote, "way above the 50% threshold, showing that producers are facing high inventory volume and low market demand," end quote. There is another potential challenge for the Chinese industry too: US competition. On Monday, the Biden administration announced that the United States will spend more than $3 billion to support the domestic manufacturing of advanced batteries used in electric vehicles and energy storage. At a news briefing, the Deputy Director of the Energy Department's Office of Manufacturing and Energy Supply Chains said that about $3.16 billion in grants will be made available to produce key metals for the batteries, such as lithium, cobalt, and nickel, in order to reduce US reliance on competitors. China is the leading producer of lithium-ion battery cells, making it the largest competitor in this regard. The funding for the US subsidies, essentially, will come from the $550 billion infrastructure bill signed into law last year in the US. Okay, next up, we need to talk about the Chinese economy, and we have some very serious developments we need to cover. But first, guys, if you're enjoying the content, don't forget to hit the like button. It really helps the channel. And for anyone who wants to go the extra mile and help keep this channel sustainable, Patreon, Buy Me a Coffee, and crypto links are in the description below. As always, thank you everybody for your ongoing support. Okay, the economy. First, let's quickly look at Chinese tourism travel and spending over the Labor Day holiday period, which just finished, and in China this is a 5-day period. Tourism spending is often a good proxy of consumer confidence. And unsurprisingly, with fears of lockdowns across the country, spending plummeted this year. We remember that it is not just Shanghai that is experiencing lockdowns and restrictions. According to a report published by Goldman Sachs Group yesterday, Wednesday, cities accounting for about 13% of China's GDP have at least some districts officially designated high or medium risk, and thus under some form of lockdown. So this, of course, is having a tremendous effect on tourism spending during this long weekend. According to the Ministry of Culture and Tourism on yesterday, tourist spending over the 5-day vacation period was 64.7 billion yuan, or $9.8 billion US, down 43% from last year, while domestic tourist trips over the break plunged 30% over last year. Commentators who do not trust the official numbers argue that the real numbers may be even worse. Next up, UK-based Japanese-owned Financial Times reports that Chinese regulators have held, quote, an emergency meeting with domestic and foreign banks to discuss how they could protect the country's overseas assets from US-led sanctions similar to those imposed on Russia for its invasion of Ukraine, according to people familiar with the discussion, end quote. The Times reports that according to its sources, so these details have yet to be confirmed, the internal conference held in late April included officials from the People's Bank of China, China's central bank, and the Foreign Ministry of China, as well as executives from dozens of local and international banks. A source claiming to be briefed on the meeting expressed, quote, no one on site could think of a good solution to the problem. China's banking system isn't prepared for a freeze of its dollar assets or exclusion from the SWIFT messaging system as the US has done to Russia. End quote. Next up, according to the Caixin China General Services Business Activity Index, which was published today, Thursday, China's service sector in April contracted at the second sharpest rate since the survey began in November 2005, and the sharpest since February 2020 during the original Wuhan outbreak. The index, which uses alternatively collected data rather than official data, which is claimed to give a more independent snapshot of the sector, fell for the fourth consecutive month to 36.2 in April, from an already low 42 the previous month. We remember that a number above 50 indicates an expansion in activity, while a figure below 50 points to a contraction. We also remember that the manufacturing PMI released over last weekend, also showed a deep contraction month on month, 46 in April from 48 in March. Both of these indexes are published by Caixin Insight Group, led by senior economist Wang Zhe, who expressed with the services data released today, quote, the new round of COVID-19 outbreaks hit the service sector hard. Overall, in April, local COVID outbreaks continued and activity in the manufacturing and service sectors continued to contract, with services shrinking more. End quote. Now, while we're on the economy, I wanted to quickly touch on a recent observation on the Chinese housing market by famous China economist or China economy expert George Magnus. Quote, it's important to understand the significance of the real estate market for the economy in China. Many people are now familiar with the paper by Ragoff and Yang, where they estimate that the real estate market, in its very broad definition, accounts for about 29% of GDP. There is probably some double counting in that, but even so, we're still talking about 22 to 23% of GDP. You can't just replace that. You can replace it over time if you had a productive program to redistribute income, promote private consumption, open service producing industries, and so on. But nothing like that is happening. The banking system in China can carry much higher levels of bad debt for much longer than they could in other economies, where banks have to mark to market much more quickly. They can evergreen a lot of this stuff. But the more you do this, and the more you don't recognize the costs of this misallocation of capital, the greater is the impact down the road. The cost will be stagnant growth going forward. End quote.